Today, I'm going to walk you through the actual math on whether or not it's better to buy a rental property or whether or not it's better to stay invested in the stock market. Today, what we're looking at is a portfolio of $236,614. That number is very specific. I'm going to show you why in a second. We're going to assume that they're invested in what we call a factor-based portfolio. Now, factor portfolios are similar to index funds, but they tilt towards small cap and value, and over the past 100 years have slightly outperformed the index fund portfolios. But to start, this is what we use with our clients. I'm going to show you what someone invested in 100% stocks would perform at over a long period of time versus all the inputs for a real estate portfolio. So what we're looking at here is 7.31% return. That's gross of taxes, net of the MER on factor portfolios. We can add in advisory fees here. Obviously, when clients are working with me, I'll add in advisory fees. I'm going to assume in this case that there are no advisory fees if someone's going to DIY it. We also have the option to compare a leveraged stock portfolio to leveraged real estate. For now, we're just going to look at a non-leveraged portfolio of $236,614 versus a purchase price of a rental property for $941,800. So the reason why this number is in here, and it's kind of a weird, odd, specific number, is because that is the average home price that Canadians will pay for a detached home in the GTA. Now, if you're in London, Ontario, where I'm at, or if you're in a less densely populated urban center, this price will likely be lower. I'm going to go with the GTA on this one. We can obviously do this analysis on a number of different properties, and the details will change. So we're going to assume a 20% down payment because that is the minimum you can do on a rental property. We're going to assume closing costs at 3%. Typically, closing costs are between 1 to 4%. In Ontario, land transfer taxes are quite high. We're going to assume closing costs of 3% of the property purchase price. We're going to assume mortgage interest rates at 4.8%. We're going to assume that the amortization is 30 years. We're looking at the average gross rent for in the GTA, which is about $3,400 a month for a 3-bedroom house. We're going to assume $42,000 a year in annual gross rent. The property is going to appreciate at 3% a year, which is 1% above inflation. And we're looking at a capped rental growth because we can't jack up rents more than what the government allows us to, which is 2% a year. And we're looking at volatility of 4%. Now, I'm not going to spend too much time talking about volatility, but it is an important concept to understand because we often think about volatility in the concept of stock markets, right? How high does the stock market go? How much does it fluctuate over the course of a day, over the course of a month, over the course of a year? But we never do that with real estate because we don't look at prices daily on real estate, or at least most of us don't. And if we did, it wouldn't change very much. But that doesn't mean that volatility isn't there. It just means that it's pretty low. And the 4% is the average volatility or standard deviation, as we call it, over the past, I believe it's like 25 to 30 years in Canadian real estate. And essentially what that means is if the average return is 3%, there is a 66% probability that the return on real estate in any given year will be either plus 4% of the average or minus 4% of the average. So within that range. So it'll be between -1 to +7%. Now we're going to assume a 5% vacancy rate. It could be more, it could be a little bit less, but we're going to assume 5% because obviously when you're purchasing a new rental property, you may want to customize it. You may want to do some improvements. You may want to do some landscaping, whatever that looks like for you. We're going to assume a vacancy rate of 5%. We're going to assume operating expenses of 40%. Operating expenses generally run 35 to 50% of the rental costs or the rental price on the course of a year. So we're going to put that in the middle and say 40. And then we're going to assume that you do put about 20%, $20,000 of additional capital expenditures into the property. Actually, as we do that, I'm going to add this to the portfolio. So instead of 236,000, we're going to say 256,000 so that we account for that additional $20,000. We're not going to hire a property manager. It's a single property rental. We don't need to add that expense into the mix. So the owner is going to be the operating property manager as well. We're going to assume a holding period of 30 years. And at the end of that 30 years, you're going to sell it for 4%. And this sell it for 4% realty cost. Now, this is important. Obviously, it subtracts from the value of the property. And what we're looking at is also capital gains taxes, right? So we're going to assume that. We're also going to look at holding the real estate in a holding company. We're also going to look at holding it personally. So we're going to start holding it personally. We're going to assume the taxable income from the individual, they're in Ontario. Taxable income from their employment income is $150,000. Puts them at 43.41% marginal tax bracket for rental property income. So let's take a look at this. So right away, we can see the winner here. Now, I'm going to dive deep into this. So just because you see the winner, stay invested, stay with me here because there's going to be some things I'm going to walk you through because this may not actually be as black and white as it seems. So what we can see here is the real estate is returning about a 4.11% return versus 6.55% for the investment. And what we can see here is that the pre-tax net worth, and this is a little bit misleading, so I'm going to walk you through that in a second, is about 1.6 million state property, about 1.185 million after taxes. Now, that is not the equity you've built into the property because this property is cash flow negative. What we're going to assume is that, and when we look at an apples to apples comparison, what we can see here is the gross to 2.1 million with after tax net worth of 1.723 million. Now, the actual equity in the property, we're gonna go to the down here. The equity in the property is 2.194 million. So why is it only showing up as 1.6 million in this scenario? And the reason is because it's cash flow negative. So there's out-of-pocket expenses, and then there's cash flow negative costs that we have to deal with. With the portfolio, there are no additional capital injections needed. But with the real estate, there are. Now, whether that comes from additional employment income or your portfolio outside of this, right? That's besides the point. We're just looking at this specific transaction of investing the initial $256,000 into a property versus putting it in a portfolio. So with that being said, because we don't need to inject an additional $596,000 into the portfolio, but we do into the property, we have to look at that as an additional expense, and that's going to subtract from the total net worth of the transaction itself. That realizes a 4.11% internal rate of return. So the internal rate of return is calculated as combined annualized return on all invested capital. Okay, so that includes the initial capital plus the rental property rental income goes towards the principal repayment of the property. I'm going to walk you through some really interesting things. The first thing I want to look at is the loan amount. $753,440, monthly payments $3,931. You've paid off this property in 30 years. You've paid $661,000 in interest, $753,000 in principal. And as you can see here, we have declining interest rates or interest payments over the mortgage, which is how it works. You pay more interest up front, less interest as you pay off the property. So I'm going to also scroll down here and look at a couple other things. So the next thing I'm going to look at is the year-by-year tax schedule. So because we have 5% vacancy rates, you're not actually going to be seeing on average $42,000 in rent. We're going to subtract that by 5%. So we're going to see $39,900 in rent, interest deduction of $35,558, operating expenses of $16,800. Your total taxable deductions is $52,538, which means that you actually do not pay any taxes. You actually get a tax refund on this property, but you are cash flow negative. And so we basically say, okay, tax refund minus the pre-cash flow equals your after-tax cash flow, which is a negative $18,000 a year. And you can see that that grows over time. Okay, the reason why the after-tax cash flow negative balance grows is because we're increasing rental income by 2% a year. Okay, and we are lowering the interest we're paying over the lifetime of the mortgage. So every year you're paying a little bit less interest, therefore there's a little bit less deductions, and so your negative after-tax cash flow will grow. So that's where we get the negative $597,000. Okay, important to understand. So let's take a look at a few other things. I love this heat map because this tells us how the internal rate of return will change based on vacancy rates and based on interest rates. If interest rates decrease and vacancy rates decrease, we're going to be over here, right? Where we're going to see the internal rate of return jump to 5.63%, potentially up to 5.81%. And if there's zero vacancy and interest rates of 3.8%, you're going to see an internal rate of return of about 6%. Conversely, if interest rates rise and vacancy rises, then we're going to see an issue, right? Because then the internal rate of return drops to 3%. And obviously, we want a higher internal rate of return. This is something that's really important for anyone who's investing in rental properties to understand. And it's something called the annual return on equity. Return on equity is essentially what you're getting back for the equity that you put into the property. So I'm going to give you an example. Let's say you have the option to buy a $1 million asset. The $1 million asset is going to deliver you 6% returns on that full $1 million. Okay, so how much is that in dollars? Well, that's $60,000 a year. But what if you only have to put $100,000 into this asset to purchase the entire $1 million? So you only have to put $100,000 of your own capital, a $1 million asset. Well, now you're getting $60,000 returns on $100,000 of invested capital. That's 60%. Now, obviously, there's lending costs. So let's say lending costs are $30,000 a year. Well, we're cutting that 60,000 in half. So your real return is $30,000 a year on $100,000 of invested capital. That means that you are getting a 30% return on your equity. Now, what you can see here is in this case, return on equity in year one is 8.4%, and it's a declining scale. As you pay off your rental property, the return on your equity gets lower. Okay, there's a reason for that. Because, go back to that example of buying $1 million asset for $100,000, if every year you have to put an additional $100,000 into it, but you're maintaining the same 6% rate of return on the $1 million asset, well, now it's $200,000 delivering a $60,000 rate of return. Then it's $300,000 delivering a $60,000 rate of return. That means that the percentage return will decline over the lifetime of the value of the asset if you pay it off. Now, I'm not suggesting here that you don't pay it off to get higher return on equities, because that will increase the risk of owning this asset. But it is important to understand this so that you understand what your actual return on equity is. What you can see here is the portfolio's return gross is pretty much, except for like the first 3 years, is pretty much greater than, even with leverage, the return equity. And that is a really important thing to understand. Now, if we look at other scenarios, like you can put less buying a bigger asset or something like that, or your cash flow is higher, then the return on equity will increase. But because the cash flow is negative in these scenarios, which is the case for most people who buy rental properties, then we're not really looking at a strong return on equity. There's not a compelling reason to get into real estate at these numbers. Now, there's a few factors here that I want to look at as well, and those pertain to risk. Most people don't understand the risk they take when they invest in the stock market and the risk they take when they invest in real estate. So when we look at real estate risk scenarios, here are the biggest ones. Maintenance and capital expenditures. You may have to put more money in if you have bad tenants and they trash the place, if you have issues with appliances, if you need a renovation but are just putting it off because it's too expensive. All of those things will create additional risk, additional expenses, which lowers the internal rate of return because there's more injection of cash you need to put in, versus with a portfolio, you never really need to put more money in if it's a diversified portfolio. Now, obviously, over the course of the lifetime, we will, but in this single transaction snapshot, we don't need to put more money into the portfolio. And then we want to look at vacancy and tenant risk, right? Like vacancy is 5%, 5% jumps to 10%, right? If compression in the markets, all of a sudden we can't charge what we used to charge, kind of moves out, buys a house, rental prices are being compressed like we're seeing right now, then all of a sudden, you may be further underwater than you were prior. And then there's illiquidity risk. It's not like you can just fractionally sell a bedroom to get more money, right, out of the property. Now, you can refinance, but that comes with a cost, right? And you have to build up equity before you can actually refinance. So illiquidity, and I'm going to give you an example of illiquidity here. And this is really easy to understand. So if I offer you two portfolio options, and I say, I'm going to offer you portfolio A, which is going to give you 10% a year. 10 years, 10-year portfolio, that's the time horizon, is going to give you 10% a year. Or I'm going to give you portfolio B, which is going to give you also 10% a year. But portfolio B, you cannot withdraw your money from. Portfolio A, at any point in time, if you want to withdraw your money, you can. No penalties, no charges. Portfolio B, it's completely locked in. You cannot withdraw your money. Which one would you choose? Well, if you were smart, you would choose portfolio A, because liquidity is an added value. If I can have something better that comes up that could maybe get me 13 or 14% a year, I want the ability to withdraw money from my investments earning 10% to get 14%, right? It's a kind of a no-brainer. Okay, but what if I told you the locked-in option could give you 12% a year? Now, that is a more compelling argument, right? Because now you're getting something extra for the risk of locking your money away. Liquidity is a risk. We have to price that in. So if we want to look at this properly, what we're actually going to do is apply a risk premium. And risk premiums simply state that this is the additional return required in order to invest in the specific risks that this asset class inherently has. So we're going to say it's 200 basis points or 2% a year for liquidity premiums right here. Now, what that means is the internal rate of return, the risk-adjusted internal rate of return, is going to drop by 2%. So if we look at this here, what we can see is the hurdle-adjusted or the risk-adjusted rate of return for this portfolio for this real estate investment is now only 2.11%. Put another way, if these came out even, if both of these said you're going to build the same amount of wealth over a long period of time, but one option's locked in and one isn't, I would need the option that is locked in to deliver greater returns than the option that is not locked in. That's logical. And I don't know, guys, I don't know about you, but in a situation like this, for all the extra work that a rental property entails, I'm not doing it. I'm not doing it in these scenarios. Like, if you have an opportunity where you can buy a rental property and you have really high rents and you get a great location, you've got great tenants, and the perfect scenario exists out there where real estate still makes sense and leveraging real estate still makes sense. But in these scenarios, the amount of time and effort you have to put in, the tax implications, all of those things with real estate versus the set it and forget it portfolio side, I'm choosing the portfolio side. And when we're looking at like rate of return expectations, we're assuming a 7.3% rate of return gross. That's a conservative assumption of what a stock portfolio is going to do over the next 30 years. What we know is that, especially over the past like 15 years, portfolios have crushed this number, like almost by double digits in some cases. So between 10 to 15% in total returns. And so when we put that into the picture, it really means that I'm going to take my chances in the stock market. It doesn't mean that real estate is out of the question for me, but it's not going to be my primary wealth builder until interest rates come down, rental prices increase, all of those things. So the point of this video is to help you think about real estate and investing in a different way by actually looking at numbers instead of just taking concepts and making big financial decisions based on that. Real estate has emotional attachments. It is a lot easier and a lot more fun to brag about your real estate portfolio than it is about your boring investments that are diversified across geographic locations that you don't day trade on, that you just set it and forget it. But in reality, building wealth should be boring. Your life should be exciting. The wealth side should be boring. One test of a good investment that I use and that I'd encourage you to use is this. If I could make this investment, but I couldn't talk to my friends or family about it for 10 years, would I make this investment? Right? And if we take that out of the equation and the ability to talk, to touch and feel, to show people, right? All that stuff with your property portfolios, if we take that out of the equation, the math does not suggest that real estate is actually going to be the better investment. So I hope this video was helpful for you. My name's Sam. I'm a certified financial planning professional. My goal with this channel is to help millennials make better financial decisions based on evidence, not emotions, and to make sure that we are doing things the right way, regardless if it's how our parents did it or our grandparents did it. It's different now. We need to make decisions in our best interests. I hope you like this video. Click subscribe if you want to see more of this content.